Last week in the YouTube video, I broke down Bob and Susan's plan using a 4.5% starting withdrawal rate, and we back tested the results from 1986 through 2025. And I also stress tested that same rate of withdrawal into the lost decade. And the results were pretty eye-opening to me and probably all of you watching as well. So today what I wanted to do is run the opposite scenario, is not dying with the largest portfolio balance, but ultimately spending the maximum amount possible over the last 40 years to see what is that safe maximum rate of withdrawal over that same time horizon. And then at the end of the video, I'm going to talk about 5 things that you can do if you find yourself retiring into a bull run like we had from 1986 through 2025. Let's dive into it. So the first thing I want to point out is we've got a bunch of different report parameters here because I wanted to stress test all of the rates of withdrawal in excess of 4%. So we started at 5% here, then we did 6% here, and essentially the 5%, the way we get that is we take this starting withdrawal amount and divide that into the $2 million portfolio balance in this case, and we're going to say 5% is that rate of withdrawal in year 1, and then we're going to adjust that for inflation each and every year going forward. So then we talked about 6% here as the stress test number 2. Then we did 7% here. 140,000 is that first rate of withdrawal. And then we also tested 8%. Just for fun, just to kind of show you some context, from 5 to 8%, ultimately what happens with that starting balance relative to the ending balance at the end of 2025. We tested 2 different asset allocations just for fun. We did the 85-15 more aggressive allocation, and then we did the 60-40, your traditional balanced portfolio, 60% stocks, 40% fixed income, globally diversified across not just the US equities, but also international stocks. And then we also have long-term US treasuries and intermediate term treasuries. Not saying this is how your portfolio should look by any stretch, okay? But just for the back test, keeping them simple, but also somewhat diversified so we can hedge against some of those downturns for US stocks like we saw in the lost decade in the 2000s. Okay, what I wanted to illustrate here is the difference in returns on a year-by-year basis and also over the rolling period of time from that 85-15 versus the 60-40, just to kind of show you the value of having a more balanced approach, especially on the downturns. Because yes, everybody wants to be aggressive when the markets are performing well. But if you were 85-15 and in 2008, your portfolio dropped 30% that year, whereas a 60-40 portfolio, it still was painful, but it was a less than a 20% drop as illustrated here on that particular line. So it's super important to note that, yes, tolerance for risk does change based on circumstances, but kind of stress testing your plan and then also looking at what happened in the past with that portfolio. And of course, there's no indication, past results should be no indication of future results. However, at the same token, it's probably nice to know, hey, what is kind of a worst case scenario with this 85-15 portfolio, with that 60-40 portfolio, okay? So the 85-15, by far 2008 was the worst, but then the 60-40 portfolio was actually worse in 2022. That's when we had the triple bear market. We had high inflation. We had US stocks were down 20%, bonds were down 14%, and then cash yielded a negative rate of return when you adjust that for inflation, okay? So it's nice to know what has happened in the past with your portfolio just so you can prepare for, hey, what is that worst case scenario? Okay, if I have a $2 million balance and, I'm 85-15 and the market's dropped by 30%, okay, that could be a potential $500,000 or even $600,000 drop in value. Okay, so percentages, it's nice to look at percentages, but also look at the real dollar amount. If your portfolio went from 2 million down to 1.4 or 1.5 million in a year, how would that make you feel? Would you be able to stay invested? Because that's the most important thing. With these back tests, hindsight's 2020, we know that behavior is a little different. When live bullets are flying around, people act differently. Okay, so it's very easy for me to say, and for you to say, if you are not retired yet, or if you haven't been retired in a bear market, in a recession, it's easy to say, I'll just ride it out. I will just stay the course. I promise you, I've been helping retirees for 17 years. The reality is I've had very smart people want to bail out of a well thought out, well diversified strategy. It is very timely because right now we have the AI craze is in check a little bit. Okay, we have the markets selling off over the last week or so. The market is very fragile. Okay, things are priced to perfection, as I like to say. You need to have a plan, have a process, and expect you're going to go through a few of these downturns in retirement. It's this is not normal going through a 40-year time horizon as an 80-15 portfolio and having a rate of return of almost 10%. Okay, evidence here by that number there. Even the 60-40 portfolio, 8.95%. was the rate of return over that duration. So I don't even need to go through all the back tests. If we look at these percentages, if we know we're pulling out 5, 6, 7, or even 8%, we know these portfolios probably held up. Obviously, the sequence of those returns matters, but we know from this period of time, in that first 4 years of this back test, the portfolio was able to get way ahead of itself. Okay. So, even though they went through the lost decade, they had a few years of a downturn there, all of these portfolios not only survived, but they thrived. And let's look at the next few slides to show you those results. So here, let's start with the 5%. We'll look at 85-15 column is here, 60-40 column is there. We'll just highlight this. $2 million starting balance, and look at the ending balance at the end of 40 years. 32 million, 24 million. Yes, this is future dollars, but even when you adjust that for inflation, that's still $11 million adjusted for inflation with the 85-15 portfolio, and then $8.1 million in that 60-40 portfolio. So meaning the portfolio had a buying power of 8.5 million at the end of 40 years, even using the 60-40 math. This is, again, that 5% rate of withdrawal. If we bump it up to 6%, still looking very solid. Inflation adjusted, 8 million for the 85-15. Inflation adjusted, 5.6 million for 60-40. Let's bump it up a little bit more. Let's get a little bit more aggressive, 7%. Now we're talking, okay, now it's stressing a little bit, but it's still it's a great outcome. Okay, either way you slice it. So 4.9 million on the 85-15, 3.1 million on the 60-40. Again, that's the adjusted for inflation amount. Okay, the beneficiaries will receive this 14 million here and this 9 million here. And then let's move the needle all the way above that safe range of 4 to 7. Let's go up to 8%. Inflation adjusted, 1.8 million for the 85-15 and 572,000 for the 60-40. So this kind of shows us we're getting close to what that safe max is going to be. So let's fast forward. I already know this solution. I already know the answer on this one. I'm going to just isolate the 85-15 portfolio, 85% stocks, 15% in fixed income. That starting rate of withdrawal is about 8.5% and some change. That was the safe max on an 85-15 portfolio over the last 40 years. Imagine if you had assumed 4% versus 8.58% starting rate of withdrawal. You probably would have needed about double the portfolio size, okay? If you assumed the 4% versus the 8.58%. Now, if you only withdrew 4 or 5%, and you could have spent 8.5%, that's okay. That could result in a higher legacy. And we'll talk about some of those things that you can do to pivot if you go through some of these prosperous times, which is no guarantee. The opposite could also be true. Retiring into the lost decade, and now all of a sudden you have the tech bubble bursting, the Great Recession in 2008. That is a totally different narrative, okay? But 8.5% was the answer. I'm not going to go through all the years, but if we look through, cash flows will continue to adjust here. Those first 4 years really helped increase the portfolio balance from 2 million up to 3.2 million. And then we went through a slight downturn in 1990, but then we had a significant bull run during this tech run, okay? This tech euphoria. Anything with a .com made a lot of money, okay? And so that lasted for quite a while until the bubble bursted, and then we have 3 consecutive years of a downturn. But even that 85-15, well-diversified U.S. and international stocks, it was able to weather the storm quite well. Entering into 2008, the portfolio actually increased from 2 million all the way up to 4.4 million. And then, yes, we had a significant downturn of minus 30% in 2008. Look at that portfolio balance here, $2.7 million, even after the Great Recession. Okay, so I think this is one of those things. Again, that sequence of returns matters. That first 4 years in that retirement really inflated that balance, and then ultimately dropped that portfolio withdrawal rate down enough to weather the storm of the tech bubble bursting and also the Great Recession. And then, of course, if we fast forward all the way to the end, you can see 2025, we had cash flows coming out of about 508,000. The portfolio made a little bit of money from the year before, and then now they ended 2025 with about $21,000. So if this person's goal was to die with zero, they did a pretty good job, okay? Now, obviously, we're excluding things like home equity, other assets, maybe cars, jewelry, whatever it might be. We're talking about just financial assets. But again, this shows you what that safe maximum withdrawal rate was for this client. But obviously hindsight is 2020, okay? Nobody knows what type of market they're going to retire into. This is why that sequence of returns is so important. But if you find yourself retiring into one of these periods of time, let's say a prosperous bull run for 20, 30 years, okay? Think about post-Great Recession, 2009 through 2025. No one has a crystal ball, obviously, what the returns are going to be over the next 10 or 15 years, but the safe max withdrawal rate so far post-Great Recession, it's probably way in excess of 8.5%, okay? I haven't backtested that yet just because it's such a short time horizon, but we'll get there. We'll get there, don't you worry. But here are 5 things you can do if you find yourself in this position where you're retiring into what we call prosperity, okay? Number 1 is the obvious one. You could give yourself some raises over and above inflation, okay? We're just assuming inflation raises on this whiteboard fireside chat, but you could also give yourself an additional raise. And I like to use the Guyton and Klinger 4 decision rules framework. And one of the rules there is called the prosperity rule. And if you find your rate of withdrawal drops 20% below the starting rate, give yourself an additional 10% raise over and above inflation. That's one of those things you can do. And you could either spend it or you could potentially gift it to your children. Maybe you have adult children that are in their 30s or 40s and, they're doing things that are expensive. Maybe they're sending their kids to private school or planning for college or, maybe sports, whatever it might be. You could potentially do some lifetime gifting to your adult children as opposed to leaving them a large pile at the end of your life. Second thing is consider Roth conversions. Okay. Consider the tax efficiency of your plan. If your portfolio is skyrocketing in value, that could also mean your beneficiaries might be getting hit with a little bit higher taxes than expected had you gone through periods of downturns in your retirement. So making your portfolio legacy as tax efficient as possible, whether that's conversions or reinvesting your RMDs into a taxable account, whatever that might be, think about tax efficiency, not just in your lifetime, but also in your heirs' lifetime. The third thing you could consider is reducing risk over time. Bull runs don't last forever, okay? So I'm not saying time the market, but if you go through a period of time where your portfolio has doubled or tripled in value and you're like, this is great, but now, with this concept, hey, if you won the game, stop playing, maybe it's time to de-risk a little bit out of your portfolio and maybe go from that 85-15 down to the 60-40 or even a 50-50 portfolio if that helps you sleep well at night. Again, I'm not advocating timing the market, but if you feel like you have a nice, healthy portfolio balance and it would make you feel uncomfortable cutting that by 20, 30, or 40% from here going forward, maybe it's time to de-risk a little bit in your retirement. The fourth thing I'd say is consider giving more to charity, if that is important to you. I'm not saying give to charity to try to guilt trip you into giving to charity, but if charitable giving is important to you and if that is going to be a part of your long-term plan, if you retired into a period of prosperity, there's a good chance you might have the capacity to gift more during your lifetime. And when you turn 73 or 75 for the majority of you, that's when required minimum distributions are going to be kicking in, which can create a lot of tax traps in and of itself. So one of my favorite strategies is utilizing qualified charitable distributions. In 2026, a taxpayer can give up to $111,000 directly from an IRA to charity without paying any taxes on it. So the key there is if you are taking required minimum distributions, and let's say that amount is $100,000 a year, well, let's say you only needed $70,000 to live on because you have other income sources coming in, let's say Social Security or pension, you could potentially gift up to $111,000 directly to charity without paying taxes, which therefore reduces your modified adjusted gross income and could prevent you from potentially going into the next IRMA tier or potentially into the next federal income tax bracket or making more of your Social Security tax-free. So super important is charitable giving and considering how that's going to incorporate as part of your lifetime plan as opposed to just at death. And then the last thing I'll say is have a conversation with your beneficiaries. If you retired into a period of prosperity and you've multiplied your wealth in retirement relative to your start date in retirement, good for you. However, you know what they say, more money, more problems. And if you're going to leave a larger legacy to your heirs, you probably want to make sure that they're going to be good stewards with those funds. So having conversations with your adult children, gathering any potential concerns or pitfalls there might be when you leave that legacy, because it may not be just with your adult children. It could also be with their spouses. Okay. You can't choose your in-laws. All right. And so this is one of those things where doing some giving during lifetime, having some conversations with your beneficiaries during lifetime can kind of shape how you structure your estate plan, whether or not you set up a living trust or not. So super key is have those conversations, consider some of the lifetime gifting to see what kind of steward your children are going to be or what type of steward your beneficiaries are going to be with their ultimate inheritance. I hope you guys found this video helpful. If you did, make sure to hit the like button. Make sure to consider subscribing to the channel. If you're over 50 and you've saved in excess of 7 figures and now you want to maximize your income in retirement and you want to minimize your lifetime tax bill and you want to worry less about money, this is why we do our channel. This is why we do our podcast. And listen, if you want help with this, If you're in a position where like, you know what, Kevin, I'm excited about retirement, but I don't want to spend time doing this in retirement. I don't want to retire into being a full-time financial planner. This is what we do day in and day out. So if you're interested in learning more about working with our firm, just visit our website, www.imaginefinancialsecurity.com, or you could start with a retirement readiness questionnaire that is linked in the description below. We'd love to hear from you and see how we can help you plan for and execute a successful retirement. Thanks so much for tuning in, and I'll see you next week.